Stocks see nervous trading ahead of the much-awaited U.S. Federal Reserve meeting and also amid continued geopolitical tension in Europe. Utilities and energy lead the decline while FMCG and consumption stocks show resilience.
Mahindra & Mahindra buys out over 17% in Swaraj engines from Kiloscore Industries to make it a subsidiary. The move is a win-win for all businesses.
Triveni Turbine tells CNBC-TV18 that marquee investors along with the promoters have bought a near 22% stake from associate Triveni Engineering as part of a group reorganization. The stock perks up.
Central Bank jumps after it exits RBI's prompt corrective action framework, while a now stronger Yes Bank perks up after its board clears off the sale of 48,000 crores of weak assets to JC Flower ARC.
SEBI chairperson Madhvi Puri Buch says that the regulator won't allow products that curb exits or exchanges to charge for public data. But SEBI is open to innovations like algos, provided there's transparency. Hello and welcome. You've tuned into Business Lunch. I'm Nisha Poddar, and with me as always is my co-anchor Pavitra Parekh. So let's begin with the markets. And yes, there is a clear nervousness that we are seeing ahead of the U.S. Federal Reserve's final verdict on the interest rate hike, and market is trying to bake in the worst that is estimated by the economists around the world. So yes, there is nervousness at this point. Even though markets opened in the red, it tried to go up and then saw a big fall, and now trying to recover about 80 points from the low point of the day. So keep an eye out on Nifty50, 17,700 levels at the moment, but still inching towards that half a percent cut. Bank Nifty, again, the biggest surge is also led by the financials and sometimes the decline as well. And this is clearly related to the health of the economy as well when it comes to the interest rates. So 0.85% down on Bank Nifty, mid caps, 0.5% down in trade. Some of the FMCG counters like Britannia, as well as the big company, the heavyweight Reliance Industries is in the positive mode today. And Apollo Hospital continues with its good run since yesterday as well. So some of the handful of companies in the heavyweights pocket on Nifty50 really in the green at the moment. Pavitra.
Hi, Nisha. So like you pointed out, there's definitely some nervousness ahead of the Fed meet. It's also the geopolitical tensions, because there was that speech by Russian President Vladimir Putin, which, and ever since then we saw the market start to fall. So also do keep that on your radar. If you take a look in the broader context of Asia, India is still holding up. So something like a Hong Kong market is down 1.5%. You have Taiwan, which is seeing cuts of 0.9%. So in that context, our markets still look better positioned. What's also adding a support to the market today is the move that we're seeing on Reliance. It is one of the few stocks in the green right now. On the downside, a bunch of the banks, a lot of the cement stocks, actually all of the cement stocks are seeing some cuts. So they'll come up on your screen. Even some of the smaller ones, in addition to these, the likes of Nuvoco, are seeing sharp cuts right now. Nuvoco is actually down over 8%. And then you have the entire Adani group of stocks, which is also exerting pressure. So some of those are going to come up. That's what's happening with the market action. We're all waiting for that big Q, which is the FOMC meeting later tonight. So first up, let's start off with exactly that. All eyes are on the Fed decision and Jerome Powell's commentary later tonight. The September CNBC Fed survey shows that on average, respondents believe a 75 basis points hike is imminent, and this will bring the federal funds rate to 3.1%. Now, respondents also believe that the central bank will remain at a peak rate for nearly 11 months. CNBC's Steve Leisman is here with a wrap-up of all of the highlights from this survey. Steve.
Wall Street increasingly embracing the idea that the Fed is going to hike and hold at a restrictive rate rather than the old idea, which was that it would stop short and then cut quickly. The September CNBC Fed survey finding that 75 basis points is the call for this week. All of our 35 respondents, except for two, who put it at 100, but mostly saying 75. Then that peak rate, the terminal rate, 4.26 now. And that is 40 basis points higher than the July survey. That peak rate is hit in March of 2023. Then the important question we asked this time, how long will the Fed hold there? 11 months is the number, with some saying as few as 3, some saying as many as 24. The recession risk now 52%, little changed in the next 12 months, by the way, little change from the prior survey. John Riding writes, the Fed has finally realized the seriousness of the inflation problem and has pivoted to messaging a positive real policy rate for an extended period of time. That's the important part there. So there's the trajectory. 240 right now, 238, call it. We reach near 4% by the end of this year, go up to that peak rate in March. And then you can see that there is some cuts built in. That's the result of some thinking the Fed turns tail quickly. But the average, again, thinking the Fed stays there and holds, with cuts coming perhaps into 2024. Rates stay high because the 35 respondents think that it takes a long time for the Fed to bring down inflation to its 2% target. We're 8.3 now. We go to 6.8 on the CPI by the end of the year, 3.6 by the end of 2023. It isn't until 2024. Just 60% believe the Fed hits the 2% target. By the way, more than 80% of respondents did not change their inflation forecast over the next 2 years because of the Inflation Reduction Act. Along with the recession risk comes an expected rise in unemployment. Take a look here, what's expected to happen. You're at 3.7 now. Go to 3.8. Not too much damage by the end of this year, but next year, 4.4. It's still an historically low rate, but you often don't see a 1 percentage point increase from the bottom outside of a recession. While these respondents have argued over the past several months that the Fed was way behind the curve in tightening policy, many also now are concerned about the opposite, that it will go too far or further than it needs to go.
All right, Steve, thanks a lot for getting us all of the highlights from the Fed survey. But on that note now, here's some opinion also that we're tracking on the likely Fed decision and all of the implications that it could have. This is from former Fed officials as well as market experts. Listen in.
If the Fed surprises the markets and goes 100 basis points, that suggests they're much more worried than we think they are. And I think that would cause a lot of tumult. But I think it's pretty clear that they'll go 75. I don't really see why they would need to move 100 basis points. I don't think they were that surprised that the core inflation numbers were not coming down, because rents are such an important driver of that, and rents are lagging. I think they will start to grow at a lower pace, but not yet.
I think they probably recognize the necessity, and they've said this many times, the necessity of the economy slowing if they're going to get a handle on inflation. And I think the Fed has been, Jay Powell has been steadfast at least since August, about the importance of the Fed regaining its grip on inflation. That's good news. I'm glad to hear that. And other FOMC members have been saying the same thing. I wonder sometimes where that commitment was a year and a half ago, when it should have been in present, but it hasn't been. So I think they're pretty steadfast. They're not concerned about a slowing of the economy at this point. Will they escape a recession? That's hard to tell yet.
I mean, the bottom line is we want to see inflation brought under control. I mean, I think that's what all global markets are focused on. And I think what's also clear is we think in terms of financial conditions, and financial conditions probably need to get tighter to accomplish that goal. This summer, after we already had rate hikes, financial conditions actually loosened in August. I think, Chair Powell's Jackson Hole speech and the CPI print in the U.S. Last week confirm that we do need tighter financial conditions. So you could say it's a bit of a painful medicine, but it's a necessary one to bring inflation under control. I think all global markets are keying off of U.S. rates at the current moment.
All right, so those are all informed and expert opinions coming in. So don't forget to catch an all-round coverage of the Fed decision tonight, 11 p.m. onwards, only on CNBC-TV18. All right, let's take you through an exclusive chat then. And there is a very small chance of a soft landing, says JP Morgan's chairman and CEO Jamie Dimon. Speaking exclusively to CNBC-TV18, he hints at the possibility of a hard or mild recession and warns of fickle market conditions as well, especially in the emerging markets. Take a listen.
A soft landing is probably a very small chance at this point, but mild recession, hard recession, they're all possible. And it's hard for me to give them odds, but they're all kind of possible. And remember, when I say get ready for it, I'm also talking to companies and investors, where my real point is we're prepared for it so we can serve our clients. We're going to be serving clients in India regardless of whether it's a hurricane or a mild storm. Markets can get pretty fickle, particularly when you're investing in emerging markets, venture capital, things where small changes in assumptions can change the value of what you think someone's worth quite a bit. So they should be braced for flow of funds that they don't particularly like. And the other thing about the dollar is that an economy which is outperforming other people relative to expectations will probably have a stronger currency. And America is still outperforming, I think, what most people kind of expect, and that may go on for a while. So the dollar may not strengthen, but I'm not sure you're going to see it weaken either.
All right, that is the word coming in from Jamie Dimon. And remember, you can catch highlights of this interesting conversation all through the day only on CNBC TV 18. Okay, with that, we're going to get into our first short break in the show. But up next, we're tracking a lot of stock-specific action. M&M is going to buy out over 17% stake in Swaraj Engines from Kiloscore Industries. So we'll bring you more on that story when we come back. Welcome back. You're still tuned into Business Lunch on CNBC TV 18. Now, stocks of Kiloscore Industries as well as Swaraj Engines are surging in trade after M&M said that it would pick up 17.4% stake in Swaraj Engines from Kiloscore Industries. This is for a sum of nearly 300 crore rupees. So what does this mean for all three of these companies? Sonia is here to break that down for us. Sonia.
So let me start with Swaraj Engines, right? Because that's the stock that's moving quite a bit. It's up 12% right now. It's hit a 52-week high. As you rightly pointed out, M&M already owns stake in Swaraj Engines, but now it has bought an additional 17.4% stake from Kiloscore Industries for 296 crores. Now with this, Swaraj Engines becomes a subsidiary of M&M. And hence, M&M gets complete control of Swaraj Engines, which is a big positive for the company. In any case, Swaraj Engines, as we know, was supplying engines to the farm equipment business for M&M, so for the tractors. And the company has done very well in the past. In fact, the revenues were up 15% just in FY22. And the last 3 years, the revenues for the company have improved substantially. Now that M&M will have complete control over the management, etc., it is a big positive for Swaraj Engines. Let's move on to Kiloscore Industries. Now, Kiloscore Industries is the holding company of the Kiloscore Group. They will get 296 crores for selling the 14.7% stake to M&M, and they'll get about 300 crores on a market cap of 1,600 crores. There's also a holding company discount that Kiloscore Industries is trading with. So that's the reason why that stock is up. Now, for M&M has been making all the right noises as far as consolidating their business is concerned. Their focus is on the core business, both auto as well as the farm equipment space, and they're looking to get rid of all their legacy businesses, even unlock more value for shareholders. Now, with this increase in Swaraj Engine stake, it gives M&M more control over the management. They have focused on growing the farm equipment business, not just on the top line, but reinventing the cost structure as well. In the quarter gone by, as per the latest data, they've gained about 1% market share in the farm equipment business. They had the highest domestic volumes of 112,000 units in quarter one, and the volumes itself went up about 18% on a year-on-year basis. Also, M&M is very hopeful about a 7 to 8% compounded growth for the tractor industry over the next 7 years, and they're taking all the right steps in order to not just grow the top line, but also come out with an efficient cost structure. Hence, it's a win-win for all three companies that are, in focus today.
All right, Sonia, thanks so much for all those important details on M&M. But shifting focus to Yes Bank, and take a look at that particular counter, over 3% gain today. But if you really look at 7 days trading action, the stock was much better off earlier in the last week, and definitely had hit a 52-week high when a lot of deals got announced. So the full resolution is what we are looking at. So CNBC TV 18's news break on this particular counter has been confirmed as Yes Bank perks up in trade after its board has cleared the sale of 48,000 crore rupees worth of weak assets to JC Flowers ARC. Ritu tells us more about this deal.
That's right. As we reported earlier, Yes Bank has now said that it received no challenger bids to the 11,183 crore rupee offer made by JC Flowers ARC to acquire its 48,000 crore rupee NPA portfolio. And therefore, in its meeting on the 20th of September, the board of Yes Bank has approved the declaration of JC Flowers ARC as the winning bidder. And separately, they've also approved the acquisition of up to 19.99% stake of Yes Bank into JC Flowers ARC in single or multiple tranches. But importantly, this acquisition of stake in the ARC is going to be subject to regulatory, specifically RBI approvals. So we'll have to see how that pans out. However, for the transfer of the NPA to the ARC, no other regulatory approvals are required. So this paves the way for cleaning up of Yes Bank's balance sheet. In another important development, Yes Bank said that the Reserve Bank of India has approved the appointment of R. Gandhi as the chairman of Yes Bank for a period of 3 years. Remember, R. Gandhi, who is a former RBI deputy governor, was also on the board of Yes Bank for 2 years during the period of reconstruction of the bank. And now with the newly appointed 9-member board, R. Gandhi is set to take over as the chairman for the next 3 years.
All right, Ritu, thanks a lot for getting us all of the details on Yes Bank. But another stock we're focusing on today is Central Bank of India. That one is surging after the Reserve Bank removed the bank from the prompt corrective action framework, which will now allow the bank to open more branches and also grow the loan book faster. So earlier today, we spoke with M.V. Rao, who is MD and CEO of Central Bank of India. And he says that the bank's asset quality is set to drastically improve this year. Listen in.
We will be coming out of the PCA because the measures what we have taken. And we know that it is only a matter of time, and also the confidence what regulator will be getting on our activities. That's why we have factored all these things when we have given this projection. I tell you, our gross NPA will be drastically coming down. Slippages, what we are envisioning for the quarter of September will be around 1. Not more than that. We have given the graded gliding path where from 3.93 we will be touching around 3.6, 3.55. In that range we have given.
All right, moving on then. After 3 successive months of inflows into India, well, Credit Suisse has studied the source of funds into the country, and the main takeaway is that India remains vulnerable if there is a global scare over emerging markets. In fact, Lata Venkatesh is here with the key findings of the Credit Suisse report. Lata.
Well, it's interesting, but that is the big and perhaps difficult takeaway for us, that the India dedicated funds, of all the funds that flow into India, the India dedicated funds account for only 13%, the balance 87%. Come through global and emerging market funds or sovereign wealth funds, which again distribute globally. Now, there's the problem therefore is that if there is a concern over emerging markets because of, say, Fed tightening, then we could lose, even if it is not our fault. Let me give you other details that Credit Suisse has put out. They say mutual funds and hedge funds accounted for 3/4 of the outflow that happened, if you remember, from September to June, those 9 months of outflows. And in the inflows, mutual funds were the ones who bought back most of it in the last 3 months. Sovereign wealth funds have been most sedate. They have bought all through those 9 months when everyone was running away from India, and their total share in FPI, total portfolio funds, has gone up from 12% in 2017 to 16% now. So that's a positive for India funds. They have separately, Credit Suisse has studied 6,300 funds, which account for about 70% of the total mutual fund, hedge fund flows into India. And this is that breakup. So this is not the breakup of the entire universe of funds, but the 6,300 funds, which account for 70% of the flows. They say 13% only came from India dedicated funds, as we just said. Emerging market funds brought in 47%. Global funds, through global funds come another 31%, and another 9% comes through Asia funds. Now, Credit Suisse also says that active emerging market funds accounted for half the FII selling in those 9 months, September to June. Emerging market funds, actually, their overweight over India has gone down. They were at about 60% overweight in 2017. Even now they're overweight, but they're only 9% overweight. And the fall in overweight is because India's weight itself has increased. It's also because of new listings, higher free float in some stocks. And as I said, outperformance, therefore India itself the weight has increased. Another list of important takeaways. 1/3 of the FII holdings are coming through sovereign wealth funds, pension funds. That is our positive because they are more sedate. They don't go in and out like mutual funds. But that is only 31%, 1/3. For the remaining, we remain vulnerable to what global global funds think about emerging markets. If they think that because of the Fed tightening, there will be outflows, then there can be outflows. But the vulnerable pocket is really financials. Credit Suisse, however, is positive on financials because that sector is undervalued, they say, and there is a possibility of earnings upgrades.
All right, Lata, thanks a lot for getting us all of the highlights of this very interesting note from Credit Suisse. With that, we're going to get into another short break now. But when we come back, we bring you the latest from the Russia-Ukraine war as Russian President Vladimir Putin calls for mobilization of troops once again in his address.
Welcome back. You're watching Business Lunch and straight to some important global developments of the day. And this is the latest coming in from the Russia-Ukraine conflict. Now, the Russian President Vladimir Putin announced an immediate partial mobilization of Russian citizens in what was a potential escalation of Moscow's offensive in Ukraine. Now, efforts to begin the partial mobilization will begin today, he announced. Putin's speech also comes on the heels of the announcement from multiple Kremlin-backed authorities in southern and eastern Ukraine that they will hold referendums on formally joining Russia this week. And also the European Union strongly condemned Russia's plans to hold referendums and will not recognize the result of the votes.
All right, that is the latest on the Russia-Ukraine crisis. But on to some unfortunate news that came in earlier today as well. Comedian Raju Srivastava has passed away after being hospitalized for a month at the All India Institute of Medical Sciences in New Delhi. Remember, he had collapsed while he was at the gym on the 10th of August, and the comedian was on ventilator support as he had suffered severe brain damage after the cardiac arrest. He was a popular name in the world of comedy and was widely loved for his impersonation of Bollywood as well as political personalities. Raju was part of the entertainment industry ever since the 1980s and also took part in several comedy shows, including the Great Indian Laughter Challenge, from where he really shot to fame in 2005. So he will be sorely missed by all of his friends and family, and may he rest in peace.